Joining us right now from the Money 2020 conference out in Las Vegas is Randy Quarles. He's the former Fed Vice Chair for Supervision here in the U.S., and now he's the founder of the private investment firm Synosure Group. Pleased to say that Randy joins us right now from the sidelines of that conference. And Randy, I do want to start off here with this idea of the new regulation that may be coming down the pike now that we're, 7-8 months removed from the initial fallout from the regional banking crisis here in the U.S. We still haven't seen meaningful change. When do you expect them to come?
Well, I expect they'll be proposed relatively shortly. I do think that, I expect they'll be made final relatively shortly. The proposals, I think, have missed the mark on what's really implied by the bank failures of the spring. The proposals are proposing a lot more capital for the very largest banks in the country, but across the system. They're proposing a lot more internal liquidity, that banks have to keep a much higher level of liquid assets, and neither of those would have prevented the problems in the spring. I think that the Federal Reserve really needs to focus on re-energizing its own provision of liquidity to the banking system and to the financial sector as a whole, as to really solve the pressures that the financial system is under, as was shown last March.
Well, I'm sure, as you know, Randy, there are a lot of members of the FOMC that would push back on that and say that they actually want to pass the baton, at least for some of that, to the private sector itself, meaning the banking sector itself, rather than having it be something that the Fed itself ends up being kind of the first stop of resort, if you will.
Yeah, I think if you're talking about liquidity, that's the wrong way to look at it. We had a system in the United States where banks were responsible for providing all their own liquidity, that the principal source of liquidity was each bank's own resources. That was the system we had through the late 19th century and into the beginning of the 20th century, and it was wildly unstable. There's just not a way that a $200 billion bank could have enough internal liquidity to respond to a $142 billion run, which is what Silicon Valley Bank was looking at at the beginning of March. That's why the Fed was created in 1913, because the system of requiring every bank to have its own high-quality liquid assets and completely rely on those for responding to a run was a definitely inferior system. It resulted in financial crises and economic depressions, and the Fed was created to eliminate all of that. But since the great financial crisis, we've moved back to increasingly requiring that banks not only have a first level of response amount of liquid assets, but that they really are expected to provide all their own liquidity, and that's just not how it should be.
Randy, in retrospect, do you have any regrets about policy choices that the Fed made with regard to the collapse of Silicon Valley Bank and some of the other lenders?
Silicon Valley Bank failed almost 2 years after I had left the Fed. So I guess if you're asking, should the Fed have supervised Silicon Valley Bank differently, most of that was during the period that I was gone, of course. I don't think that the regulatory framework was really at fault. There's been a lot of analysis of that. The regulations were completely adequate to have prevented the failure of Silicon Valley Bank, or at least ensured that there was a proper official sector response. I do think that there is too much of a willingness on the part of the supervisory system in general to focus on non-core issues and not focus on the most important issues, which in the case of SVB was liquidity and interest rate risk and concentration of deposits. And that's something, the supervisor's job is very hard. I don't fault the supervisors for that at all, but it is something that we have to continually work on to ensure that the supervisors are focusing on what's most important and not just trying to boil the ocean.
What are some of the non-core issues that you're referring to that perhaps regulators are overly concerned with?
Oh, there was a great deal of, if you look at, again, to take Silicon Valley Bank as the core example, although, two other banks failed in the spring and they were both supervised exclusively by the FDIC and not by the Fed. But if you look at Silicon Valley Bank, the Fed's been very candid in saying, here's the supervisory approach that we had to it. They had 32, I think, matters requiring attention or matters requiring immediate attention, which is the supervisors speak for matters that had been identified for urgent remedial attention, very few of those had anything to do with what really mattered to the bank, which was liquidity and interest rate risk. And even those that did have something to do with liquidity and interest rate risk were not at the highest level of importance, and were more about process as opposed to you must address this risk now.
I know you've moved on from that job as vice chair, but Randy, would you support giving the regional banks a little bit more power, a little bit more autonomy to make decisions with regards to these regulatory issues we're talking about? And I'm just going back to a lot of the criticism that was put towards Mary Daly's way and whether the San Francisco Fed was asleep at the wheel. But there has been this call as to why the reserve banks still need to be dependent on the Fed board to sort of give them the green light to do some of the regulatory actions that they want to do.
Yeah, I'm very much in favor of empowering the reserve banks up to a point. There's a pendulum over decades. This is not just since the great financial crisis, but particularly in the Fed system, but across the bank regulators, where you empower the folks in the field and then you get a lot of differing decisions, so that institutions that are really very similarly situated, it depends on what particular local supervisor they're talking to. So then the system tries to centralize more of the decision making, and that results in slowing down decision making, which was some of what we saw in the Silicon Valley Bank and Signature and First Republic situations, where you just had the center being a bottleneck. So you try to swing that back out. You're trying to strike a balance. After the great financial crisis, the Fed, long before I got there, of course, but the Fed brought everything back into the center again as part of trying to respond to that age-old question of where should the center of gravity be. I think it is appropriate to swing that center of gravity back out somewhat to the reserve banks without undermining the consistency of decisions that are made across the entire system.
Randy, before we let you go, the Fed, of course, is also looking into perhaps revising the cap on interchange fees for that merchants pay to the debit card companies every time a customer swipes their debit card. Is this necessary? And if so, what would reducing the cap, lowering the cap, mean for the banking system?
I myself don't think that it's necessary to revisit the cap. The idea of the cap was a very well-intentioned measure that was intended to be pro-consumer, that you could shift some of the surplus from the banking system to the consumer. It's very clear that all that it has done, we now have all of the data and a lot of experience with the first iteration of the cap, and it's just shifted that surplus from the banks to the large retailers. There's no particular reason that the government should care where that surplus goes between the banks and the large retailers. That's for them to negotiate among themselves. None of it is going to the consumer, or very, very little of it. And that would be the case if you tried to further ratchet down that cap today. It would just transfer more over to the large retailers.
All right, Randy, thanks for taking time for us. We're going to have to leave it there. Randy Quarles, of course, he was the first vice chair for supervision over at the Federal Reserve, now at the private investment firm Sinosure Group, and joining us today out at the Money 2020 conference in Las Vegas.